Our next guest says the economy remains remarkably resilient. Joining us now is Moody's Analytics chief economist, Mark Zandi. Mark, I feel like you've been calling for a Fed pause, disappointed in the last hike. And now, we've gotten a bunch of stronger data than expected. Does it make you rethink that position? Do you think they should be done?
Oh, they should be done. Yeah. I mean, Sarah, the key here is inflation. And in my view, inflation is coming in. Consumer price inflation peaked at 9%-ish back last summer. We're at 5. I feel very confident. We can talk about why that inflation is going to be closer to 3 by the end of the year and back close to the Fed's target by this time next year. Obviously a lot of uncertainty around that, but I feel less confident in that forecast at the current rate of interest than I have in a long, long time. So and of course there's a lot of other things going on. Banking system's still under a lot of stress. Economy's slowing. Recession risks are high. You add it all up. I don't think there's any need for another rate increase. Not now.
I think the market's been on board with that view, Mark, and then you just get some confusing data like what we got from the University of Michigan, inflation expectations over the next 5 years jumping to 3.2%, the highest we've seen in a while.
Yeah, I don't put too much weight on the University of Michigan survey. I mean, it's a small survey, jumps around all over the place, and I'm not sure what to make of it. I mean, if I'm going to pick a confidence survey to look at, it would be the Conference Board Survey of Consumer Confidence, and that's rock solid, very close to its long-run average, hasn't budged. Feels like it's saying that the economy's in pretty good shape, but doesn't need another rate increase. And inflation expectations more broadly, they feel like they're coming in slowly but surely. I don't think it's a straight line. I mean, especially for consumers, it's going to take a while for them to truly believe that inflation is coming in because they've been through a lot over the past 3 years. So, but I wouldn't read too much into that University of Michigan survey.
Why are you so confident that the inflation rate is coming down to 3% when it's more than double where it should be on the target, and Fed officials don't seem as convinced as you do?
Yeah, 2 reasons. One is the cost of housing services, which is a very large share of the inflation pie, particularly in the consumer price index. That is, I feel this with a high degree of confidence, that is going to come in because we know that rents have gone flat to down in many parts of the country, a lot more supply hitting the market. There's still a record number of multifamily units in the pipeline going to completion, and they'll get completed. And demand is weak because of the previous surge in rents. So we have now demand destruction. Households can't form because they can't afford to buy a single family home or to rent. So that means lower rents, and that translates into lower cost of housing services over the next 12 months. And the other factor is vehicle prices. The really great news that came out of the last CPI report, Consumer Price Index report, was a decline in new vehicle prices. We've been waiting a long time for that. Finally getting enough production in Japan and Germany. Their supply chains are now finally getting back in order. They're producing more cars, and that means more cars on dealer lots, and that means weaker prices. And so that's the start of some consistent price declines here, I think, over the next 6-9 months. So, and that's another big part, a chunk of the pie, of the inflation pie. So those 2 things by themselves, Sarah, I think argue very, very strongly that inflation is going to come in here in a reasonably graceful way, at least through the end of the year into next.